Okay, so here we run an example. So this is a company called Speedo. So they produced a swimming suit. So after the 2012 London Olympic Games, they began to work on a new generation of swimming suit. So that's their new production line. So that's called a Fast Skin Generation 4. And before they launched the project, they actually spent $100,000 testing the market, and the test proved to be successful. Well, the thing is, in your capital budgeting, do you really consider this test of marketing and that cost of $100,000 relevant? Well, the answer is no, because it's spent before the project starts. So it's really a sunk cost, and the sunk cost is not part of the cash flow. So here are more details about the project. So it tells you about um, the life horizon of the project. It's a 3-year project. So basically, it tells you after 3 years, the product is out of date, and then it also tells you that the cost equipment is $200,000, and we will use straight line depreciation method and have a $20,000 ending book value. And we also need to increase the fabric materials, okay, which is the inventory, which is net working capital. That requires $20,000 inventory to be maintained. So that upfront, we need to pay $20,000 to build up inventory. And then it also says the inventory will be recovered at the end of the project. So basically, when the product is gone, there's no need to maintain $20,000 inventory, so we're going to sell it out for cash. And also it says the operating costs are about 90% of the revenues, so that's a pretty low margin. And when we sell the machine, the equipment, at the end of the project, it will be sold at $30,000, and we have a discount rate is 10%. All right, so the first thing we can do here is try to get the try to get the depreciation. Since right here we use straight line depreciation, it takes the formula of a beginning value minus ending value. So this is total amount of depreciation divided by number of years. So each year the depreciation amount is the same. So we divide the whole total depreciation by number of years. So you will find 60,000 for this case. And right here is your income statement for the next 3 years. So you have a revenue at 4,000, 3,000, 2,000. These are all given numbers. Operating cost is 90% of the revenue. Okay, so 4,000 times 90%, that's 36. 3 times 90%, that's 27, and so on. And depreciation is 60,000 for each year. That's a straight line. That's the same. So based on the revenue, cost, and depreciation, 4,000 minus 3,600 minus 60, you would have an income before tax. So this is your earning before interest and taxes. And based on this 340 is your taxable income, and this multiplied by the 40% tax rate. So you will figure out the tax you're gonna pay is $136 for year 1, and then you find the net income, which is 340 minus 136. That's 204. And the key part here is to add depreciation back. Since we deducted non-cash term at the beginning, we have to add it back to recover the non-cash effect. And then we have an operating cash flow of $264 for year 1. And we're going to apply the same method for year 2 and year 3. So this is the operating cash flow for all the 3 years. And then we look at the terminal cash flow, which occurred at the very end of the project or at year 3. So basically, when you sell the machine, it can be actually sold for $30,000, and that price is offered by the market. Okay, and you do have a $30,000 cash received, and this number is greater than the $20,000 you originally reported for the ending book value. Remember, at the beginning we reported the ending book value is $20,000, and based on that $20,000 we compute the annual depreciation. So here we got some conflict, and actually you make a capital gain. On the book it is worth $20,000, but you actually sell it for $30,000. You make a capital gain of $10,000, okay, which is a 30 minus 20, the salvage value minus ending book value. And then the IRS will certainly charge a tax on it. So we do have a tax on salvage, which is the capital gain, which is the salvage value minus ending book value multiplied by the tax rate. So $30,000 minus $20,000 divided by 40% tax rate. So you actually pay $4,000 tax on salvage or on capital gain. So your total cash flow resulted from the sale of this machine is $30,000. You receive the whole price minus the tax on capital gain. So that's $26,000. And then we put everything together. We have the capital expenditure or capital investment. We have a change in net working capital. We have operating cash flows. We have a salvage cash flows. So right here, we spend $1,200,000 up front, and we spend another $20,000 to build up inventory. And this $20,000 will be recovered at the end of the project. And our operating cash flow is like this. And then the $26,000 is from the salvage value minus the tax on capital gain. All right, and you add them up. So this net cash flows is your free cash flow. Okay, that's your free cash flow. And you have four numbers from year 0 all the way to year 3. And when you apply 10% discount, you can calculate the net present value of the project. Okay, so I will not help you to calculate the NPV. We have done this multiple times before. All right, so right here, as you can see, there's a tax shield approach. You can either get the net income and then just directly add depreciation back, or you just use sales minus costs. This is called a gross margin, and then you times the after-tax rate, and then add depreciation times tax rate. This is another way to calculate operating cash flow. So, and another issue here is, what if the working capital changed over time? So basically, depending on the level of sale from the next year, you will need to maintain different levels of net working capital. For example, at the start, you purchase $20,000 inventory, and then your business expand, then you will need to have a $30,000 inventory in the next year, and then your business start shrinking. You will need to have only $15,000 net working capital, and then at the year end, you just have you don't need any inventory at all. So your cash flow is not based on the net working capital per se. In fact, it's based on the change of net working capital. From 0 to $20,000, you spent $20,000 cash for it. So that's negative 20 right here. From $20,000 inventory to $30,000 inventory, you spend another $10,000 cash for it. Okay, so that's the cash flow effect from change net working capital. Again, from $30,000 inventory to $15,000 inventory, you liquidate half of your inventory, so 30 minus 15, so that's $15,000. After your liquidation, you will receive $15,000 inventory. And from 15 to 0, you will have another $15,000 received from liquidation of inventory. Okay, and here is a big example